Well, hello everyone. Welcome to Trading a Smaller Account. My name is Barbara Armstrong. I'm a coach and senior manager with Schwab. And I feel like I need to reintroduce myself. It feels like it's so long since I have been here. I appreciate you guys showing up. I managed to catch a flu bug when I got back from Anaheim, so I've been kind of down for the count. I hope none of you that I had the privilege of meeting there suffered a similar fate. But we have got a lot to cover today because I haven't been with you for the last 2 weeks, and I hope you all had a great Thanksgiving and are well on your way to enjoying this whole holiday season. But today what we're going to talk about is, when we look at setups, what kind of rules do we wrap around our trading, and when do we place a trade, and when do we look at it and go, looks delicious, but I think I'll pass. And what might some of the reasons behind that be? So we're going to do a little bit of trade management, a little bit of trade review, and then we're going to place some new trades. So I hope you guys are ready to roll. If you are not following me on X, I encourage you to do so. My handle at Barb Armstrong CS. I'm posting content and charts there on a daily basis that I hope you'll find helpful. Just before we get into the thick of things, know that options, and we do a lot of options trades in this class, example trades, that they do carry a high level of risk, and they aren't suitable for all investors. Also, we use the Paper Money software application on the Thinkorswim desktop platform. Looks like, smells like, feels like real money, but it's not. So it is a great place to learn, to hone your skills, to make sure you understand a trading strategy before you consider trading it in your live account. There are some nuances and differences. One is that short option positions will never be assigned early in Paper Money, but that can happen in a live account. And just because something's worked out well in Paper Money or in the past doesn't guarantee that that's going to continue in the future. So like I said, we're going to do a quick market overview. We're going to do some trade review and some trade management, and then place some new example trades, especially, since I've been gone. Didn't somebody sing a song about that, since I've been gone? But since I've been gone, we've hit a lot of targets and one exit on positions that we already had. Okay, if you are brand new to this class, feel free to type a greeting into the chat so that we can welcome you. We link arms here together every Monday and Friday, and we've been doing that for, I don't know, probably 7 or 8 years now. So to TM and Sia and Alfred and to Will, who I am going to get to meet in Houston next week, and Kevin and Chris and Marcus and Frank, who's here in the Salt Lake City area. We live about a mile apart. To Josh, who I just saw in California, and the rest of the gang, thank you all for taking the time to be here. I really appreciate it. I think that we've got Ben Watson with us in the chat as well today, and you'll want to follow Ben in as well, on Twitter at Ben Watson CS. And Ben does all these live workshops. So the next one, like I mentioned, is going to be in Houston. We don't have that up on this page only because registration is now closed. ProCaddy said he's going to be at the Houston event also. So come up. So I'd love to meet you. Maybe we can take a selfie together. That would be great. And then the weekend before Christmas, we did one the weekend before Christmas, I think in Miami last year. And I thought, well, the turnout rate's going to be really low because it's the weekend before Christmas. We were packed to the rafters. So if you're interested in advanced options, this is an introduction to advanced options. So here we go. Please feel free to join us. Ben Watson and I will be there. Rachel Dashel will be there as well. And a whole cast of people to help support you. Then Kevin Horner and Ben will be at this event in Dallas. And then we're over to Washington, the Westin Bellevue. I'll be attending that event as well. So that takes us through the end of January. But if you want to see the rotation, we have a lot of stuff already listed, all of the first quarter and a lot of things listed in the second quarter. So there you go. Schwab.com/events. Okay, so let's get out and look at the platform. And first thing in the morning when the market opens, 4 days a week, Kevin Horner does a class called Trader Talks. It's archived every day except Friday when they talk ETFs, typically with James Boyd. And they do such a great in-depth overview of what's happening in the markets that, you really do want to try and catch that if you can, or catch it in the archives. But, just to do a quick review so we know, are we bullish? Are we bearish? Here we've got the S&P 500. We had a bit of a pullback to this 100-day moving average. So really, the first time it kind of closed below the 30-day moving average and then kept on falling for a few days. But we're back within a stone's throw of the all-time high. We had a bit of a diagonal resistance line setting up here, and it broke above that, came back to retest, and has continued on. Now, when we look at the NASDAQ, this is our tech-heavy index with no financials. I mean, the chart almost looks the same, right? Year to date, we're up 21%, another diagonal resistance line set up that it broke out. And again, maybe not quite as close to the all-time highs, but not so very far away either. So if we look at it, we'd say, okay, looks pretty bullish. Now, some people question, including me, why we look at the Dow. This is actually the oldest index. I think it was established in 1894, 1896. And it was the only show in town for a long time. So maybe we look at it out of like some historic nostalgia reason, but it's close to an all-time high. But the Dow 30 is based on the price of the stock, not the market cap. So I think we get a little more skewed look. If you look at NVIDIA, for example, if we look at the Dow, like it looks like it would be a heavy hitter, right? Like it's the largest company in the world from a market cap perspective. And I'm going to post a little video on NVIDIA that you'll want to check out. It's just around 2 minutes long. But, it's a huge, huge company, but it's not even in the top 10 as far as sector weighting on the Dow because of its price. So where on the NASDAQ, it's, 13% of the NASDAQ and somewhere between, say, 6 and 8% of the market cap of the S&P 500. But hey, if we're looking at it, it's close to an all-time high and up 12% year to date. And the Russell 2000, if you want to keep talking about NVIDIA, the market cap of this entire index is less than the market cap of NVIDIA. And this one is, back, whoops, I've got the fibs up. Let me change that to a regular line. We're back up, within a hair's breadth of all-time highs here. 25.41, what was the high today? 25.38. Yeah, so, up 13%. Yeah, so there we go. Okay, so, and where's our VIX? It's down at that low end of the range again. Interesting, isn't it? Because it seems to me, there's a lot of nervous Nellies out there in the market right now, but there we go. Okay, so let's kind of go back and forth between placing new trades and reviewing some of the old. So let's start with the short put verticals, okay? So with short put verticals, we had 3 that hit targets. So Tesla was one of them. We put this short put vertical on at 425 and 420 back here on the 10th. And it hit our profit target, which was to get out when we had 80% of our max gain. And this one expires on the 5th. So that probably worked in our favor on that one, on Tesla. So you see, we opened it here on the 10th. We got out December 3rd. So we were in this like right almost to the bitter end. So we got paid $1.75. So what does that mean we were risking? Go ahead and type that into the chat. What were we risking if we were paid $1.75. Whoops. Can you tell I was posting stuff on X? Well, we were risking $5, right? The difference between the strikes minus the $1.75. So our risk on this was $3.25. And then what did we actually make on this? Well, $1.75 minus 34, we made $141. Okay. And so, we call that a base hit in our world here. If we can just keep on doing that. Somebody said, it's crazy to, you're ridiculous thinking you could make $100 a week on an account that starts around 20 or 25,000. And yet we have, in this example account, and this is a paper money account. So sometimes we get paper money fills. We're not as emotional about it, like all that kind of stuff. But our return on risk, and let me just, make it quicker here. It would be $1.41, which is what we made divided by what we were risking, which was $3.25, right? And that worked. So that worked out to 43%, which is pretty high, which is on the high end for us because we like to try and put our strikes low. Yeah. Yes. So Josh said that's more of a sack bunt moving, moving the runner over. Like, yeah, call it what you will. Yeah. Baseball was interesting this year come the series, wasn't it? I don't know how many of you watched that 18-inning game, but it was quite epic. Okay, now we did another one on GM. And so let's go look at the chart first on GM. And back when I was a client, and many of you know that I started in this whole world as a client, I used to hate it if I hadn't been kind of going to classes for a while, if when they reviewed old trades that I hadn't placed. But it's important to understand how to calculate your profit or loss and return on risk, all of that kind of stuff. So we did a short put vertical. We put it on this day. So it had gapped up on earnings and kept on going, came back and looked like, it had come back to an area of support and was bouncing. So we did a short put vertical at 68 and 67. Okay, so at 68 and 67, that's only $1 wide. And so when we come back to our monitor tab now, how much could we have lost on this one? How much were we risking? And we did 7 contracts, but how much were we risking per contract? So go ahead and type that into the chat. So we were paid $27 per contract, and we bought it back when it was worth a nickel. So, that's our 80% goal, right? Right. I know you were all agreeing to me, with me. So we ended up making $22 a contract times 7 contracts. You may say, well, that's not very much, but it's $154. We'll take it. Beats a poke in the eye with a sharp stick, as I like to say. And again, I'm not going to write it all out, but base hit. Score 2 for the base hit. Now there's a runner on first and a runner on second. Maybe we'll load the bases by the time we're done. And then what was our return on risk? Just to go through that math. What? Nobody wanted to do the math on this one. So 27 minus $1. So we were risking 73 cents and we made 22. So that was a 30% return on risk. So check. Okay. And we'll do, somebody saying that's nice dinner money. Yeah, as long as you're not at Ruth Chris. Okay. So last one, and then we're going to go and place a new trade. We're going to look at Apple. So Apple, we did a short put vertical at 265 and 260. And on that one, we got in on November 10th. I thought I had put this way over here. So we got in on this day. and it hit our 80% target on the 25th here. And so that's where we were on Apple. We come to the monitor tab. And so here we were paid $1.54. How many contracts did we do? One. Why only one? Well, because we don't want to risk more than $500, and we were risking how much? We were risking 346, right? If my math serves me correctly. So our risk was, I'm going to put that over here for our return on risk. It was $346. So that's why we didn't do two contracts, because we would have been risking, $700 or close to it. So we came out at $1.24 was what we made. Again, we're happy. You know, another base hit. Now we've got runners on first, second, and third. Yeah, so that's a 36% return on risk. Okay. Okay, so let me just pause and have a quick look. Are there any questions on how we calculated that? Yeah, somebody's saying if you went to In-N-Out, you could like feed a family of 4, I'm sure. Or Ben and I went to a chicken and waffle house. You know, and that was really affordable too when we were in Anaheim. Hold on, I have to have a quick drink. Yeah, somebody said, you know, like to be in and out of something in a week or even 2 or 3 weeks, you know, and making a return on risk of 30% is pretty reasonable. And for a lot of people, that would meet their trading criteria. Yeah, so how much capital to employ? Okay, so OMK, in someone in the chat is saying, so for a $25,000 account, if I was able to risk 500 per contract, then we could deploy 50 such trades. Typically in this class, because I trade a lot in this class when I'm here, you know, and typically I'm here, you know, most of the time. But, you know, if we come to the activities and positions, we typically have somewhere between 10 and 20 trades on at any one time. Okay, like in right now, if we look at this, we're at almost $33,000 and 20,000 of it is sitting in cash. So, you know, a lot of our little employees, if you think of every dollar as an employee, they're on a holiday break right now. So, you know, we want to fix that. Okay, so let's go and look at how we might employ a couple of our languishing dollars there. So how about we look at the Goog alphabet? So if we come over, you know, we had a couple of trades here that worked out nicely. We had put them on this date, and we were going to compare them, and we've already done that. So, you know, we can take these off our chart now. We've done both a short put vertical and a long call vertical. So I'm just going to leave that, because if we do another long call vertical, I'll just change the strikes and move it up. But could we do a short put vertical below 313, you know, and get enough premium for it to be worth the money? We are going to look at, just a sec, trade management. We're going to look at a couple of trades that we have to close today. I don't know if Microsoft is one of them, but okay. So let's talk about Goog, the Goog first, and then we'll come back. So we're going to come to the trade tab, and we're going to December 19th. That's only 2 weeks away. So That's not very far. So how about we come out to the 26th, and then we want it to be below what? Below 313. Why below 313? Because we see this as a support level, right? Like, could we do the 310 and get enough premium? And what does this candle mean, like at a support level? Well, one, it's an inverted hammer, so that in and of itself is a bullish sign. Two, it's a harami. Today's candle is totally within the body of another candle, so that doesn't even require confirmation. That's considered a complete setup on its own, even though today's candle's live, so it could change by the end of the day. So, who knows? Okay. So let's come to our trade tab and see, could we come down to this 310? And when we come out to December 26th, our strikes are $5 wide. We're okay with that. We have a 10-cent wide bid-ask spread. We've got over 1,000 contracts, 466 on the books at the 305. So if we look at that, we get $1.25. And if we're saying, well, like, what does that mean? Is that enough? Are we getting enough juice for it to be worth the squeeze? So if what we can make on this is $125 and we're risking how much? Well, $5 minus that, $3.75. That smells like about 30% to me. So it's 33% potential return for a trade we'd be in for 26 days. And we've got a 31% probability of that expiring in the money, which means we've got a 69% probability of it expiring worthless, like at the 310, at the 315, about a 40% chance of it expiring in the money. Now, what this is based on is like a complex mathematical calculation based on the option price and where the stock's currently trading. It's not taking our superlative technical analysis skills into account. Now, and I say that kind of tongue in cheek, because superlative technical analysis skills or not, it may work out and it may not. And that's why position sizing is important, because sometimes we have a not, and we're going to look at two that are not. And somebody's saying, like, Chuck is asking, like, do you want weeklies? Well, on a stock that's as heavily traded as Google is, like already over 14 million shares traded today, one of the concerns about weeklies is that often there isn't enough open interest, that liquidity might be an issue. So we might be able to get into the trade, or the bid-ask spread might be super wide, but this is a 10-cent bid-ask spread, and we've got 486 contracts traded today alone. 741 were on the books when the market opened today. So we have enough. But if we came out to January, we see that we've got thousands of contracts. Okay, so but for this short put vertical, what's the advantage of the shorter time frame? The advantage of the shorter time frame is that time decay will happen at an accelerated rate. What's the problem is that if the trade goes wrong, there's less time to recover. And I mean by trade going wrong, if the stock pulls back, we have less time for it to bounce. Okay, and then we're going to make this a first trigger sequence, right click anywhere on here, opposite order, say when this is worth about 22 cents, buy it back. So that would be 80%. This is a $5 wide spread. And we're going to make that good till canceled, confirm and send. Oops, wanted to just move the whole thing. So we're risking 377. Is that less than 500? Yep. Yeah, somebody's saying, is the day after Christmas not a concern? Well, it's not a concern in that our expectation is that we'll be out prior to Christmas. Yeah. So, but it does expire the day after Christmas. We're going to put that in our short put vertical bucket. Okay. Okay, so that's the Goog. Now, could we also, and some people love this and some people hate it, but, when we look at Google, which is up 60, almost 68% year to date. And this is just a lovely uptrend that we're looking at here. A lot of the time trading above the blue line, which is the 10-day moving average. It's only come, well, I'm zoned in here. Let's look at a 3-month. Yeah, it's kissed the 30-day moving average once in the last 3 months and has otherwise traded above it. And so, might we be bullish on this stock? And it's in the communications sector. I think, let's see. Oh, I've got a link that. It's in the communication sector, which has been, one of the strongest sectors over the last month and 3 months. So could we do a long call vertical? And it's now trading at 321. Could we do the 320 and 325? Like just last week, it was at 328. So if we came in and said, okay, like what would that set us back? And we might want to come out to January for this to just give it some more time. And we could do that. I mean, we've got 13,000 contracts at the 320, 4,600, or we could put on one of each and just compare them. Would you like to do that? Okay, let's do that so we can then compare the difference in time frames as well. So we're going to look at buying a vertical, 240. So how much could we make on this? We could make up to 260. But our example trading plan says don't be greedy. If you've made 50%, call it a day. Okay, so we're going to come and say, okay, right click, create opposite order. I couldn't have stayed at 240 to make it easier for my brain. Okay, now I'm going to get my calculator. 245 times 1.5, 367. So let's make it 365. We'll make it okay. We're live in the market, so we'll just go with that. So that's a long call vertical. And we're going to compare it to the short put vertical and the long call vertical with the January expiration. Okay, so we're placing 3 trades. Now, if we were only placing the one trade, would we have done 2 contracts? We would have done 2 contracts because we can risk up to $500. So, but because we're doing 2 examples where we're going to compare them. So this one is 250. And so between the 2 contracts, we're risking 500. Okay, and this one is January 16th. Well, Asiya is saying it looks like an iron condor if you put them together. Are you talking about these trades on Google? So let's talk about that for a sec. Once I put this trade in. Create an opposite order. We're going to make this 375. So that's about a 50% gain, just a smidge over. The other one was a smidge under. Okay, long call vertical. And again, we're going to compare to the December 26th long call vertical and short put vertical. Fire in the hole. Okay. Okay. So we've got those 3 teed up, and somebody said that kind of looks like an iron condor in that we have this short put vertical at 310, 305. Oops. That's my value. So short put vertical at 310, 305. And that's December 26th on the right. And then we did a long call vertical at 320, 325. So I'm going to put actually this line here. We're placing these trades today. So I'm going to repurpose this line. It's a long call vertical, 320, 325. December 26th is one of them. And then January 19th is the other. We're going to make it 320. So an iron condor, and I know most of you know what an iron condor is, but just in case there's someone out there that does not, an iron condor is what I like to think of as a credit spread sandwich. And it isn't really a bullish trade. It's a neutral trade. It's the kind of trade that you would consider if something was busy going a whole lot of nowhere. And this stock is not in that category. I mean, it's up 67% year to date. Like, holy smokes, Batman. Like, that is quite something. So it's rocking it. And so, we've sold a short put vertical, a short call vertical. If we were doing, an iron condor, we'd be adding a short call vertical above where we think it will go. Instead, what we're doing is a long call vertical because we are bullish. And so we are expecting this to continue to go up, and we'd love to see nothing better for it to go up lickety split so that the value of this goes down and the value of this one goes up. Okay. So that's the plan. Okay. So we just did 3 trades on Google. So check on that. Now, I had said, in my introduction, we were going to talk a little bit about, when to trade and when not to trade. So if we look at 5, and this is a 3-month chart. Let's kind of back the truck up a bit and take a look at a longer perspective. So, for a time, really until April, which is when everybody was on the struggle bus. But since April, this stock has, almost tripled. Well, it has tripled in value. It's up almost 70%, up 68% year to date, just gapped up on earnings. And so could we come down to this, say 166 and maybe sell a short put vertical? Or if we're really bullish, could we do a long call vertical? So when we come here, first of all, whenever I just see monthlies, it's like, ooh, am I going to have the kind of volume I need? Well, if I look at the long call verticals for January, I've got lots of volume here, but well, actually, it's interesting because they've tightened up since I last looked at them. 1030 to 1080, that's 50 cents. This is 80 cents. It's a little wider, but it's under 10%. So given how much it's gapped up, and then we may want to come over, a lot of these discount retailers seem to be really shining, like the Dollar Generals, the Dollar Trees. So what are the analysts saying? Well, they're raising their price target 197, 188, 215, 195. Here's B of A, like such a range, right? 132, that's down here. Like, I don't know if they missed the boat or that's where they really think it should be. Here's 210. It's currently trading at 175. So, but the net of it is that I'm not seeing anybody lowering price targets. It's raise price targets. But could we maybe, if it's at 175, could we get enough profit to be able to do a 170, 175 and still make some money? Which means it just has to stay where it is, basically. So at 270, we could make 230 bucks on this. Now, we're not saying our goal is to make 230. Our goal at 270 times 1.5 is to make is to get out when it's 405. That would be a 50% gain. So if we say, well, that we'd be willing to do, we're risking $270. So how many of these could we do? We could do 2. We'd be at 540. So that's, we're up a fair bit in this account this year. Not that, that's where we'll be by the end of the year. But so we are going to create an opposite order and say when it is worth 405, we'd like to buy it back. Go forth and prosper, 5. Yeah. Yeah, so that's another thing that sometimes when you're looking at a decision, you don't want to just look at this chart. Like, how are other stocks in the hood doing? And what do I mean by that? Like other companies that sell similar products, like Dollar General. Well, it's on a tear. It's up at 6% today. It was probably up more than that yesterday. If we look at since earnings, how much is this little thing up? Excuse me. I wasn't making it up when I said it's up 21% more or less in 2 trading days. So like the neighborhood, you talk about go forth and prosper, seems to be doing a bit of all right. And when we look at this one, but when we look at the 3 of them, 5 is up the least. This is up 16% in 4 days. So Chuck is saying, why 50%, not 80%? The higher your target, the longer you have to stay in. And then the more opportunity for it to have a pullback and maybe create a bull flag or news can come out. Like, as a retail trader, we're small, we're nimble, we're quick. And so we want to get in, make a little money, get out, put the money in our bucket. Now, and I like that you asked this question, and many of you who are regulars are probably sick of seeing it or hearing me say it. Like when I started, if I could make 100%, I wanted 100%. And you know how often I got it? Almost never. Almost never. And I think it was John McNichol was doing a class, and they had a 50% gain on a long call vertical. And he said, well, maybe we should take our profit. And I thought, what kind of wimp move is that? Like, I'm being honest. These were the voices in my head. And then I thought, well, just a minute. Maybe if I set my target at 50%, like, and if at Thanksgiving dinner, you had said to someone, can you believe this woman is doing trades? They're typically 3 to 6 weeks, 20 to 50 days. And she's suggesting I get out with a mere profit of 50%. Like, I don't even know why I watch her webcast. Like they'd be chucking the rolls at you and going like, you can do that and you're not committing a felony? Like it's so, and sometimes when the market is super volatile, we're saying like, hey, you know what? Sometimes that 50%, like it's going up and we get to 30% and then it turns around. And if it turns around, could we say, you know what? In this case, if 30% is good enough, sometimes we put in a target of 25%. And that's why. And if you're wondering where I'm getting these, crazy numbers from, like you want to subscribe to the channel and there's a button if you haven't already subscribed in the bottom right-hand corner. It's Trader Talks from Schwab Coaching. And when you first get to Trader Talks, whatever is currently being taught or whatever's up next is what will come up. But if you come to playlists, and I'll be adding another one to my mini session playlist, number 10. It'll be the evening star pattern. Because I've done a bunch of short minis on different candlestick patterns. There's probably going to be 18 or so by the time I'm done. But here are these example trading plans that we kind of live by in this class. And every once in a while, we'll massage one of our rules, which is kind of more of a guideline. And one of those is our profit target. So like I've said, our profit target in this example trading plan for the long call verticals is a gain of 50%, but sometimes when we're up 30, we'll take it. Or sometimes we'll set a target, if it's already through both strikes, of less than 50%, because we have to get too close to max gain to get the 50% that we're looking for. So we'll just set a lower target. So the long call vertical and short put vertical, here's some example trading plans for you. I'm going to be redoing a whole bunch of these, but at the very bottom, there's a bunch of short videos on Thinkorswim, like how to customize your charts or a watch list and all that kind of stuff. And some of these are disappearing, and it's not because they aren't watched, it's just because they've been around for a while. So I will be re-recording them. So stay tuned. Okay. So we need to go look at, okay, I'm not going to go through the math on these, but let's go review another couple of trades. We did one on 5, so we've done 4 trades today. Okay. So CVS. CVS, we bought some stock, we had a target, and we had an exit. And this one hit our exit yesterday. And so we were down on that. We had 50 shares. We were down $4.22. And so we were down $210 on that one. So I guess we left our runners on base, on that one. So that one we were out on. And then AMAT, we did a long call vertical on AMAT, and that one hit our target, and we got out. So we placed it this day. When did we get out on that? On the 17th, we got in. On the 26th, we got out. And this is the nice thing about setting targets, is that you can you could be, traveling for Thanksgiving, or like me, swigging, cold and flu medication, but that one hit our target, and we were out at a 49% gain. And then Amgen, so it looks like our long call verticals were sponsored by the letter A. This one we got in again on the 17th, out on the 28th, and we had a 50% gain on that one. That was another long call vertical. Okay. And then the short put vertical, I wonder if we're still in that. If we're still in that, that's not looking good. We are still in the short put vertical, and now we're down on that. So we'll talk about that one Monday. But we have 2 long call verticals. Roku is one of them, where so Roku has had quite a comeback. I was going to exit this trade today because we were down more than 50%. And Micron was the other one where we were down more than 50%, and both of those have rebounded. And so we'll look at those again on Monday. So, here's our long call vertical list. We haven't met in 2 weeks. 1, 2, 3, 4, 5, 6, 7. We have 8. We have 8 of those trades in play. Okay. Yeah. So somebody's saying Alta is on a tear, and it may well be, but we're out of time for today. The other one that we were going to look at today was Illumina. So we'll have to push that one till Monday. And interesting, because year to date, it's actually down, but it's really had a nice move to the upside recently. And we've got this bull flag happening. So we'll come back and look at that one again on Monday. And STX, diagonal resistance breakout. So I was going to use this as an example when I was looking before the market opened today of like uptrending, but we have this diagonal resistance line and it hasn't broken out yet. And today, what do you know? Ask and ye shall receive. Yeah, and Kevin is saying, of course, Roku and Micron rebounded and I'd already closed them out. And sometimes that happens. And that the temptation is to beat ourselves up, right? But all you can do is say, I looked at these positions and I made the most informed decision I could at the time. And that's all we can do. So for Eric, who's here for the very first time, welcome aboard. Keep on coming back. I encourage you to follow along, place these trades in your paper money account. so you can kind of get the hang of these strategies and all of that good stuff. One thing with the surveys, and I don't think there is a survey today, but when I get a survey, I'm, our trade on 5 has not gone in yet. So I'll go in and make sure that goes in. But we've got, we placed several new trades today on Google. We're going to compare the December 26th expiration with the January 16th expiration on the long call verticals. And then we did a short put vertical as well. We also did a vertical on 5. So when we look at this, this is our day order. Oh, it's now trading at 290. So, I mean, like we wish we got in at 270, but hey, if we have to pay 290, at least it's going in the right direction, right? For our long call vertical. There we go. So we'll make another stab at getting that one in. I appreciate you joining me today. Thanks to Ben for his help, the guys behind the scenes for bringing this class to life, and to all of you for bringing your positive energy to the table. I'll see those of you who are in Houston next week. I'll hope to see most of you Monday. Get out there and hug someone you love, everyone. Who isn't blowing their nose all the time? And I'll see you Monday. Have a great weekend. Bye for now.